Fractional Reserve Banking. Let's have a look. Good afternoon everyone, Florian Heise here, and I've got my stein of coffee. I hope you're all having a lovely Saturday. Now I could lie and tell you all that I've had a really good day working hard in the yard and getting lots of stuff done. But I've had a relaxing day doing nearly nothing. A rare treat these days. Just hanging out and chilling. Sometimes the best days you can have. And I thought after the video I did this morning about Bloomberg, trying to normalize negative interest rates, I was talking to Rachel about fractional reserve banking. And I thought, probably would be worth doing a video just to introduce this topic to a few people, because it's quite interesting. It's quite interesting and a little concerning. So this is an article about it from Investopia, and let's go through this and then have a bit of a talk. So fractional reserve banking. What is fractional reserve banking? Fractional reserve banking is a banking system in which only a fraction of the bank deposits are backed by actual cash on hand and are available for withdrawal. Because we've had some people post on social media that they've had trouble actually getting their money out of the banks, out of the CommBank, one guy posted. So they only have a fraction of the money at hand. So think about it like this, money used to be claimable for precious metals, for gold. And then all of a sudden they started devaluing that. Now the money that we have, on our bank account that you can see on your phone, only a fraction of it is available in the bank. So, in some ways we already have this e-cash that the IMF are talking about. Just think about it. Let me know in the comments if you've tried to withdraw some money and you've had issues. So, this is done to expand the economy. Okay? I'm sure that's the only reason why it's done, to expand the economy, by freeing up capital that can be loaned out to other parties. Sure it is. Many US banks were forced to shut down during the Great Depression because too many people attempted to withdraw assets at the same time. Okay? Yeah, that doesn't explain that it means okay, that's kind of relevant, but still. So let's understand fractional reserve banking. That's what happens when you have a bank run, when people lose confidence in the bank. Greece, they limited the amount of money people could withdraw to like $100 a euro, and they're going to talk about this here and other examples. So understanding fractional reserve banking. Banks are required to keep a certain amount of cash depositors give them on hand available for withdrawal. That is, if someone deposits $100, the bank can't lend out the entire amount. That said, it isn't required to keep the entire amount either. Most banks are required to keep 10% of the deposit, referred to as reserves. Okay, 10%. This reserve requirement is set by the Federal Reserve and is one of the Fed's tools to implement monetary policy. All this central planning of the economy and these free markets, I think most people just don't appreciate it really, or they don't dare to think of other options or ways of doing things. And that's understandable. That's completely understandable. It's just because you're so ingrained and exposed to a system. So increasing the reserve requirements takes money out of the economy, while a decrease in the reserve requirements puts money into the economy. Okay, that's what happens. Fractional reserve requirements. So I need to have a stein with this. So some banks are exempt from holding reserves, but all banks are paid a rate of interest on reserves. This rate is called the interest rate on reserves, or the interest rate on excess reserves, the IOR or the IOER respectively. This rate acts as an incentive for banks to keep excess reserves. Banks with less than 15.2 million in assets are not required to hold reserves. Banks with assets of less than 110.2 million, but more than 15.2, have to have a 3% reserve requirement, and those banks with over 110.2 million in assets must have a 10% reserve requirement. So the fractional Reserve Multiplier effect. Are you awake yet? I need another shot of coffee. So, the term fractional reserve refers to the fraction of deposits held in reserve. For example, if a bank has 500 million in assets, it must hold 50 million or 10% in reserve. Analysts reference an equation referred to as the multiplier equation, with which, when estimating the impact of the reserve requirement on the economy as a whole, the equation provides an estimate for the amount of money created with the fractional reserve system. This estimate is calculated by multiplying the initial deposit by 1 divided by the reserve requirement. So using the example, the calculation is 500 million multiplied by 1 divided by 10%, or 5 billion. It should be noted that this is not how money is actually created. It is only a way to represent the possible impact of the fractional reserve system on the monetary supply. As such, while it is useful for economics teachers, it is generally regarded as an oversimplification by policymakers. Okay, so let's jump on to the surface and let's graphically represent a few of these ideas to try and get a better understanding of it. And I'll probably do the simplified version of it based for the economics. So say, here you are, you're coming up to the bank, to the big bank building. You got your $100,000 that you want to deposit in the bank. You want to be a good citizen. So you go into the bank and you're going to go deposit into the bank. You can tell I'm working on Rachel's surface now, so it's all working really nice. Okay, so you come to the bank and you deposit your $100,000 here. Now, what they want you to think is that the bank is required to hold a portion of that money, a portion of that money away here. Okay, that's what they have to hold in reserve. And then what they will do is this portion over here, they will divide it up into different portions, invest and do other things to get a return on that money, to invest it. So it's going to all different parties like this. So that means when you come back to the bank, because there are lots of other people doing the same thing, all of these reserves that they have, the reserve stacks from all the other people, will be enough to cover your costs of going to the bank and asking for some money, because not all people are going to withdraw all their money every day, and then the bank is making a return on the money that it's lending out. Okay, so that sounds like that's a nice story, isn't it? A nice story. Here's another suggestion. Your money, your $100,000 that you put in there, allows the bank, say they have to have 10%, allows the bank to lend out or to 10x it. You can tell I've been going to marketing things. So here's your deposit with the bank. Do you want 100 grand? And then it gives them the power to lend out all of this additional money, just so long as their books are still fine. They've still got that on the books. But now they've got all this extra capacity here to give people credit. So, you can go and buy this overpriced, 4-bedroom, crappy house in Sydney, which has fallen apart, and you borrow all of that money. So you've given the bank the capacity to lend that amount. So it's more than just, them holding a portion of your money and giving the rest, or they can use it to generate more cash. It's not as simple as we were taught. But even this isn't what happens in Australia. In Australia, we have an entirely different, we've got capital regulations, and it's to do with the assets that the bank owns. And I will look at that in another episode, because that is even more worrying, because they've got tier 1 and tier 2 ranked assets. And what do you think would happen if the valuation of certain assets drops? What do you think could happen? Anyway, guys, thanks for joining me for this relaxing Saturday episode. Like, share, and subscribe. And please, thanks for all your support, for watching the channel, for the patrons, people using the Amazon referral link. It makes a huge difference, and I really appreciate it. And I'll see you all next time. Bye for now.